Yo, what is really good? Welcome back to Infinite Investors, the home for all new and non-investors. I'm Curtis, and today we have got a jam-packed video for you. This is the weekly portfolio update series. I'm going to be taking you through a lot of things today. I'm going to be taking you through the amount of money I expect to get into dividends this month. I'm going to be taking you through the 4 new stocks that I've bought. I'm going to be talking about the pound rising. I'm going to be talking about Brexit and Bojo, Boris Johnson that is. I'm going to be talking about PPI. I'm going to be talking about what to expect potentially in the last 4 months of the year. And I'm also going to talk about 10,000 jobs lost due to, you've guessed it, the trade war, and my thoughts and feelings along that. On that. So if you want to know more, please like, please comment, please subscribe. I'm on a mission to get to 2,500 subscribers and get the world of investing out to more people in a clear, simple and transparent manner. But first, let's get into this, man. I am going to be expecting, as you can tell from the title, about £157 and maybe 14p in dividends this month. So that's coming from 9 stocks, and those are, the first being Barclays. So Barclays, I should be expecting about a £12.30 dividend at some point this month. Lloyd's, I will be expecting a £26.38p dividend this month. Legal and General, I'll be expecting a £27.41 dividend payment this month. Aviva, I will be expecting a £38.57p dividend this month. And you know what, this is really good because those 4 that I've just mentioned, just to pause there, is like, it's obviously well over £100, but it does help with the fact that a lot of these stocks have dropped quite recently. We know what's happened to the banking stocks due to Brexit, PPI and a whole bunch of other factors. We know what's been happening to insurance has been kind of falling by the wayside as well. So getting these dividend payments does help reduce the amount that I've potentially lost in capital gain appreciation, as you can see from the red figures on your screen at the moment. But yeah, let me carry on. I'll be getting a little payment from Trig, about £2.95. I'll be getting another small payment from Chevron, which will be about £3.57. I'll be getting a payment from Imperial Brands. They pay quarterly, which is good. So most of the payments that I'm talking to you about are the final dividend payments. No, interim dividend payments. Interim, final? The final? Interim? There might be interim, I can't remember. Anyway, I'm getting a quarterly payment from Imperial Brands, which will be about £17.52. Also getting a payment from Sentiment. Sentiment's been doing really well recently. It's kind of tailed off this past week, but I'll be getting a Sentiment payment of £25.84, and then the S&P 500 will be giving me a small payment, probably around the £2.60 mark. So all in all, those 9 payments, and of all of the stocks that I currently hold, I hold 24 stocks now, because I'm going to be talking you through some of the new ones that I've purchased. 19 of them pay dividends, and obviously this is just 9 of those 19. I've got a couple more to pay me in October, about 5 more to pay me in November, and the rest ain't till 2020, man. The rest ain't until 2020, but I've still got another 7 stocks that will be paying me dividends over the next 2 months. And then I've got 1 stock that will continue to pay on a monthly basis as well, which I'm going to be talking about next. So yeah, a lot of dividend payments, which is really good. My annual yield at the moment is about 6.26% on average on my portfolio. And so what that basically means, at this current valuation, I should be expecting about £1,000 on a yearly basis in dividends. Now, obviously, I'm going to keep on investing, keep on growing that portfolio, so that figure will always continue to rise. Maybe not the yield, but the amount I should expect on an annual basis, as I continue to invest into these dividend stocks as well. So yeah, I think dividend investing, as I always mention, it's not something I really cared about when I first got into the stock market world. I wasn't really interested in getting all of these small, minute payments. I always felt that, I'd rather just care about capital gain, growth, appreciation. But we've seen a very turbulent market that dividends has been the thing that's actually held up. And it's actually quite nice to start to see your dividends grow. And then, over the course of, a year or whatever, or 2 years, 3 years, 5 years, these dividend payments will be much bigger. You'll be receiving maybe £300 dividend payments or £200 dividend payments on a particular stock, and that's obviously going to be a lot more material, and you're going to feel the effect. But me, I just get that money, I invest it straight back into different stocks, and obviously hopefully that can continue to increase. Now, I have purchased 4 new stocks in the portfolio over the past couple of weeks. I've been talking to you guys about the new stocks that I've shortlisted. I think there was about 10 stocks that I shortlisted, maybe 8 to 10. I've decided to buy 4 of those stocks and add them into my portfolio. So I'm going to be taking you through the ones I've decided to add into my portfolio, and the reasons that I've chosen to put these stocks in. So the first one is gold producers. Where you at, boy? Gold producers, where are you? There you are. I've added excusez-moi, I've added gold producers into the portfolio. So gold producers is an ETF that basically tracks companies that produce gold in some way, shape or form. It also kind of invests in a few other stuff, which I'm going to get into as well. So the reason why I invested into gold producers, well, in the last year, their growth was 75%. This is according to justetf.com. I think the turbulence in the market has helped. And me personally, I think the turbulence in the market is going to continue. I talked about it in a previous video. If you think about all of the events that have happened this year, from changing prime ministers to Brexit to trade wars to the American election that's going to be happening, to Germany, to recession, inverted yield curves, to there's been a whole bunch of factors that's happened this year. So I think it's been a very, very turbulent year economically, and I think that's going to continue into 2020 and maybe even to 2021. So because of that, I think a lot of people generally, their natural behavior is to go into commodities. They go into commodity trading, whether it's physical gold, silver, precious metals, etc. And I think a lot of these companies that deal in that seem to have a bit of an uplift. So we've seen that in my portfolio. If we go to Sentiment is my best performing stock, being a gold miner. They've got a great balance sheet, but I think a lot of their growth is attributable to the simple fact that gold is rising because of what's been going on in the economy. So because of that, I felt to capitalize on that a little bit, go a little bit defensive from that standpoint, and introduce this into my portfolio. With this specific fund, there's 68 holdings, some cash in different currencies like Hong Kong dollar and a few other different currencies as well, gold, physical and mining stocks. I don't really like to hold gold directly. I prefer to hold gold producing businesses like Sentiment, as I mentioned, because there is a fundamental side to it. So if they can make money in other ways and other activities, I can potentially benefit from that standpoint if, for example, the gold market isn't doing so well. What this fund also does is it lends to business and governments for a greater return. So to increase the return that it makes, probably the reason why in the last year it's grown like that. You can look at the graph on your screen and see that, that 75% growth I mentioned to you, and I think one of the benefits of that is because it lends to other businesses and to governments for a greater return. So when it lends, from 100% of the return, 67.5% goes back into the fund, and 32.5% goes into their bankers' profit, and they've got to make their money. And some of the companies that it lends to are well-known names that like Alibaba, Facebook, the German government. There's loads of companies and governments that the fund lends to specifically. I think loads of funds do this, but I just obviously calling out as I felt like it was a selling point for this fund specifically. The question you might ask is there a bit of a duplication with me holding Sentiment and this? Potentially. It's a very good question. However, Sentiment only makes up 1.02% of this fund, so the other 99 point whatever percent, or 98.8% is basically Barrick and 66 other holdings that range from 0.1% to 9% of the holdings. One thing that people might not like is that there are no dividends. This is purely a growth ETF. It's a growth fund. I think it's a recession stock personally, and that's the reason why I decided to buy it. So I'm not too worried about the dividends. I'm buying it for a capital gain appreciation. I'm probably going to try hold it for the next year or so, based on the turbulence and based off the recession. And then when we start to potentially come out of the recession, and if there is a good, benefit over the next couple of years, I might just get rid of it at that point. We shall see. But that is probably my horizon for this specific stock that I'm currently bought. The next introduction to the portfolio is, excuse me, again, my nose is a little bit stuffy. SEMB, JP Morgan Emerging Markets Government Bond. Now, with this one specifically, there's been a 22% return in the last year, 77% return in the last 5 years. Oh yeah, Free Trader got this nice little cool feature now, so you can see the return. You can see what that looks like. I don't know why it's doing 8,000s when I do that, but whatever. But yeah, you can see the return over the last 5 years. And so it basically invests in emerging markets bonds. So it invests in governments from emerging market nations. So some of the nations include Kuwait, Russia, Qatar, Brazil, Abu Dhabi. There's loads. I think there's 481 different types of holdings that they've got, which is all around emerging markets and so forth. This one does pay a dividend at 4.5%, but one of the great things about this is that it pays a dividend on a monthly basis. So, I don't really invest in bonds, but right now I'm doing something strange for a little piece of change. I'm putting money into a bond, one, because it's paying a monthly dividend, but two, I think there is a nice moderate growth outlook for this potentially in the future. I did look at other things like VUCP, which is like corporate bonds, but I think they tend to be a bit more volatile when the market is potentially going to go into a recession, more so than I think a government bond. So I didn't want to get into another volatile bond. I thought, I haven't even gone into that one, but I wanted the one that I think is going to be a little bit more stable in terms of its performance as we're entering into a recession. So I do expect the performance to be gradual, but the monthly payment will definitely insure against losses. Now, obviously, it is quite an expensive stock. Expensive in terms of its capital, not in terms of its valuation. So it's obviously £93.48 at the moment for one share. I've currently just got 3 shares. I bought 3 shares in it, and obviously that was about £300 that I spent on that. But obviously, I think over the long term it's going to be okay, at least definitely in the medium term, shall I say. So that is the second stock that I've introduced into the portfolio. The third stock, we need to now go on to the other side. We're going to go to the basic side, and I'm obviously having to utilize my basic account because you've guessed it, when it decides to low up, I have bought some REITs and put some REITs into my portfolio. So the first one is British Land, God save the Queen and that. And this is a REIT, a real estate investment trust. If you don't know what a real estate investment trust is, I've got videos. Please go check out my other videos. But I'm going to give you a very, very, very quick summary right now. Very quick, but don't start complaining that it's not in depth enough. I've got videos already sitting there, neglected, feeling unloved. So go check those videos out. But anyway, this is a REIT, which is a real estate investment trust, and basically it's about property, land, and that is basically the investment vehicle. So with real estate investment trust, they have to distribute 90% of their revenue to shareholders as a minimum, and the way they do it is called through a property income distribution. So it's done basically through dividends. They also might make money through non-property activities, which is called, aptly titled, non-property income distributions. This one typically is mainly property income distributions via the way of dividends that it pays to our shareholders, and it does that on a quarterly basis as well. So property income distributions are taxable as property letting income, but different to the property that you might have physically yourself. And the way to look at it is that it's similar to US stocks in terms of withholding tax. So US stocks, when you get a dividend, there's a withholding tax of 15%. That's done at source, and there's nothing you can do about it. It just comes, it's already taxed by the time you reach it. It's pretty much the same thing here, except it's done at the basic rate of 20%, which is the basic UK tax rate percentage. Some institutions can claim that back. Typically individuals can't, I don't think. Mainly like charities and other companies can potentially claim that back, but I think if it's in a child's trust fund, for those of you with kids out there, you can actually fill out a form and claim that 20% back and potentially get it gross as well. For this specific REIT, the current yield at the moment is 6.16%. Obviously the yield fluctuates depending on obviously whatever the share price, but at the moment it's 6.16%. The dividends are very well covered by their earnings, and the payout ratio for this is 94%. In terms of some of its holdings, so I bought some and then I bought a little change more just because I had some change I put back into the account. In terms of some of the holdings for this specific REIT, it includes things like Regent's Palace, it includes things like Sainsbury's, and just to not confuse you, it's not Sainsbury's as the stock, it's the land that Sainsbury's shops sit on top of, if that makes sense. It's the land underneath it, it's not the shop itself. So Sainsbury's, so this basically owns the land, and Sainsbury's pays this company, a leasing fee, to have a shop on top of the land. Basically, that's what it basically means. It also includes Drake Circus, but not Drizzy Drake. Obviously, it's the one in Plymouth. Yeah, that one. Like anyone knew about that, except if you're in Plymouth, obviously. It also includes things like Ealing Broadway. This REIT owns Ealing Broadway. Like, imagine that. So like if you're from West London or from anywhere in London, and you can literally be like, yeah, man owns Ealing still. Like, I own a bit of Ealing, so it's true, you own a little bit of Ealing if you own a bit of this fund. So no one in Ealing can chat to you because you own them. Anyway, REITs are good defensive stocks. So I think if we're entering into a recession, as you can see, I've gone a little bit defensive. I've put my Captain America shield up, and I've decided to go a little bit defensive now just because of what's happening in the market. But I do see a lot of growth potential within this. The share price for this one has been falling, so I do think it is a buying opportunity. As you can see on the graph here, it has been falling, so hopefully it's a good buying time. The forecast, however, is 58% growth in the next 1 to 3 years, and that's based off 10 analysts, according to Simply Wall Street. So I'm hopeful that this will rise in the future, so there'll be some capital gain appreciation, but obviously the quarterly dividends at 6.16% will definitely help as well. The second one, I bought another REIT, in the words of DJ Khaled, another one. I bought another REIT, and this REIT is Landsec. Now, obviously you know what REITs are now. The future performance for this one is anticipated to be about 57% in the next 1 to 3 years. There's a 5.8% yield in terms of dividends. It went ex-div a couple of days ago as well, so I'm going to get a little bit of a change in October, probably like a couple of quid. I'm not really too worried about it. In terms of its holdings, it includes things like, I think there's about 130 holdings across the UK. It includes things like Southside Shopping Market in Wandsworth. It includes the Blue Water shopping market. It includes the O2. Turn the O2 into the O3. Listen, it includes the O2. It includes Novotel hotels. So, when you're, taking your Tinder date to the hotel, you could be like, yo, baby girl, I own this. I have anything you want. I own this. Because when you own the land, you own the brand, innit? Listen, you can stunt on whoever you want to stunt on if you buy a REIT, because you own, the Novotel. If you've not seen the movie The Founder, actually, I'm just going to go on a tangent. If you've not seen the movie The Founder, go and watch it. It's on Netflix. If you own the land, you own the brand. That's my new phrase right now. If you own the land, you own the brand. And, the way he took over McDonald's was simply because he owned the land that McDonald's basically sat on top of. And then he was able to literally take the brand. And so literally, I think owning land is a very important thing physically. But, the very next best thing is owning these REITs, and, you can own a little bit of the land. Anyway, that's just me going off on a bit of a tangent. But listen, those are the 4 stocks that I've introduced: the gold producers, the emerging markets bond by JP Morgan. In terms of the expense ratio, so I think the gold producers was about 0.55% and the emerging markets was 0.45%. If you don't know what an expense ratio is, go and check out my ETF videos. They will explain to you what an expense ratio is. So they're not that high compared to some of the other funds like Trig and JP Morgan Emerging Markets Fund. I seem to have a lot of JP Morgan. I might have to look into that. And yeah, but that those are the expense ratios, so they're not that high. And obviously then I bought these two REITs as well. So those are the four stocks that I've introduced to the portfolio. I will still continue to look at what stocks are available on free trade and other places when they come. But I think I've got a lot now. I've got about 24 stocks now. So to be honest, some things have to go. I think when I first started investing, I went too gun ho with certain stocks. Like I was buying two of the same industry, three of the same industry, and now I realize that some of those things I need to get rid of. But they're at a loss at the moment, so I'm definitely not going to sell while they're in at a loss. So things like some of the banking stocks, I'll definitely try and reduce my holdings there. Some of the insurance stocks, I might try to pick one rather than having both. That type of thing, in order to make room for other stocks. So I don't want to just keep on adding more and more and more stocks and just basically spreading my money too thin across a whole bunch of stocks. I want to be a bit more focused and targeted. So there is definitely some Rubik's cubing, some tweaking that I've got to do to this portfolio, but at the moment it's in a okay place from a diversification standpoint, whether it's geographical, whether it's sector, whether it's market cap. I think it's okay in terms of a diversification standpoint from asset class as well. And I think I think I've got enough holdings. I earn enough dividends from some of these holdings that it's a decent portfolio, but I do need to do some tweaking in order just to get it a bit more fine-tuned. So that's probably going to be my focus over the next couple of months to try and get there. But it's going to be difficult because of what's happening with the banking situation. In other news, the pound has been rising. So this week saw a 5-week high. Listen, there's nothing to be super happy about, but it's in response to a no deal Brexit. Is that right? Yeah, a no deal Brexit. So there is no opportunity to be a no deal Brexit. So it's a no deal Brexit basically. And Bojo's no deal strategy didn't pass through Parliament. There might be a general election, so there's still a lot of uncertainty that we've got to be aware of. But a no deal Brexit, a no deal Brexit should be economically a good thing for investors that have UK stock holdings as well. So hopefully that should be a positive thing, but there's naturally going to be a lot more uncertainty to come within the market. Also, this week saw, let me just CYBG is really looking like CITV right now. It's a joke, it's a cartoon right now. Like, it's just been dropping. I don't personally invest into CYBG anymore. I just hold it. So what that basically means is that, I do a dollar cost averaging approach. For those of you know that I continue to add money on a monthly basis. But now, because I've got so many stocks, I have to allocate to a certain amount. So I used to do £1,000 a month. I now do minimum 1,500 a month, but it'll be about 1,500 to £2,000 a month I add to this portfolio. And because of that, I have to allocate, because some stocks, as you know, like Facebook, Chevron, the SCM bond, they're like £100 stocks, right? So because of that, that's already 3 stocks taken out of the 24 that I currently hold. So that means that there are stocks that I'm just not going to include and not add money to on a monthly basis. But what I'll do, depending on what's happening in the news and happening in the market, I will allocate my capital accordingly. So with things like the banking stocks, because CYBG and all of the other banking stocks have been hit so hard because of PPI, I currently am not adding any more money to it. I'm not selling. I'm just going to hold until I feel like I see a silver lining, until I feel like I see light at the end of the tunnel. Then I'll continue to add more, hopefully that it will rise, and potentially get rid of 1 or 2 of those as well. So that's my strategy with some of these banking stocks. But yeah, CYBG announced that up to 450 million hitting PPI because of the last week's claimant. I did say last week in my last video that I think it's ending, but it seems like everyone's been rushing to make their last week's claim. Gladstone Brooks has been on a madness, probably doing adverts every 3 seconds just to make sure people use them to claim. And now obviously people have been claiming, so we shall see. I don't think all of those claims will go through personally. I think a lot of them will probably fail because they probably won't be eligible, but we shall see. But anyway, once these people have their money, then I think the share price will start to hopefully recover. We shall see. It's something to basically be aware of. I wanted to also talk to you about the 10,000 job loss. So I'm taking this information from MSN, and I didn't even know MSN was still about like that, but clearly they are. But anyway, there is a report that, and what am I going to put on the screen? I'm going to put S&P 500 on the screen for this. There is basically a report that was done by a firm called Challenger, Gray and Christmas, and they do a monthly report, about the job market in the US. And they basically said employers have announced that in August they cut 10,488 jobs, and the reason why is because of the trade war. And I personally, you lot might not think that's significant. Me personally, I think that's extremely, extremely significant to know that this trade war uncertainty, this back and forth, this ping pong, this yo-yo in between China and the US, this dick measuring exercise that's been going on has basically cost, 10,000 people jobs. That's 10,000 families that, are in a bit of more of a precarious predicament because of these news headlines and because of these trade war headlines. So it's something to bear in mind, because I personally think that the UK and the US have a lot in common, and the UK generally follows suit with a lot of things that happen in the US economically, and so it's not unlikely that if this trend continues, the reason why I'm calling this out is because if this trend continues into into September, into October, where more companies are getting rid of, staff because of the trade war, then that could be further compounded by the potential recession, and that could definitely seep into the UK. So the reason why I'm, calling it out is because I think it's definitely something to be aware of, be mindful of, not to be, overzealous in the market when you're investing, because you never know what the future is going to hold. Definitely try and save some money in cash and make sure that, you've got a few months disposable, that in case the worst was to happen, you've got a few months disposable that can see you through until hopefully you find your next job, if that situation does occur. And a lot of companies and a lot of people tell you about this stuff way too late. They tell you about what to do when you've been made redundant, or when you've lost your job. Why not? It's no good learning about how to handle losing your job once you've lost your job. You should know it in advance so you can prepare in advance. It's like putting you in a swimming pool and telling you how to swim by putting you into the deep end. Like, do you know what I mean? You still got to go into the shallow end. You got to practice. You got to know what's going on before you actually jump into the river or something like that. So that's my philosophy. So that's the reason why I'm calling that personally, because I think it's definitely something worth looking into. There was also this article from Associated Press which talks about September being typically the worst month for the S&P 500, but it was a bit clickbaity. But one thing it did say, which was very, very interesting, is that in the last 10 years, September's been a decent month for the S&P 500, especially when there's an impending election coming up as well, and so we might see a little bit of a rise in the S&P 500. I talked about it in my previous videos. I think if you're new to investing and you want something easy or simple to invest in, you can't really go wrong with the S&P 500. It's generally the index, which is what the market is based on, and so I think it's definitely a way to gradually, as you can see from this chart, gradually raise your wealth over the course of however long is your horizon. I'm trying to put a little bit more into the S&P 500 now on a regular basis, but I still see this as my very, very super long-term retirement fund, and I'm talking like 20-year fund. So this is something that I'll continue to add 150, 200 pounds, a couple of maybe 100 pounds in on a monthly basis for the next foreseeable future, and then hopefully the compounding effect by that should be definitely something that should be good. But one thing to call out is, as I've kind of mentioned, because there are so much uncertainties with the yield curve, with people worrying about recession, etc., it is probably anticipated that there's going to be some volatility within this over the next few months. So don't be concerned if you start to see this kind of tank or lose a few percent over the next couple of months. I think that it's the macroeconomic conditions that we've always been talking about that's going to have an impact. And my personal take would just be to continue to buy on a regular basis, try and ignore what's going on from that standpoint, and that might be beneficial for you. But I will leave the link in some of these articles in the description in case you want to read more and get some further context from that standpoint. Listen, I hope you found this video useful. If you did, please like, please comment, please subscribe, and I will be back next week with another portfolio update. I know some of you are thinking, Curtis, you didn't review the free trade 25 stocks yesterday. No, I didn't, and the reason being is because I did another video on how to invest £250, and it just takes me quite a while to do that kind of video, so I decided to do that video instead. So go and check out that video, but I will this weekend make sure I do the free trade 25 stock video as well, and give you my take on those new stocks that would have hit the platform already. Listen, I hope you found this video useful. If you did, please like, please comment, please subscribe, and I will be back with another investment video next time. Take care. Peace.